From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for July 26, 2024. Checking the calendar, the Brewers are home this weekend with the Florida Marlins, and the Braves, remember them? They're in town for 3 days. And the sounds of Harleys are everywhere for the homecoming, from the factory to the lakefront to the Brady Street Biker Bash. Keep an eye out for those riders. And we also have German Fest underway at the Summerfest grounds, which is just like the Harley homecoming, but with accordions. And if that's not noisy enough, the Thunderbirds are here with the Air and Water Show through the weekend. Today it's all animal stories all the time. Let's start with cocaine-fueled sharks off the coast of Brazil. The media coverage is a feeding frenzy. It ranges from shark eating bales of cocaine from smugglers with the menacing Jaws theme playing in the background. And then there are the news outlets that are looking for a younger audience, asking and using the annoying Baby Shark song. If you hear the Baby Shark song enough times, you'll want to be thrown into the ocean. A man from New Jersey who was just trying to protect his daughter is facing animal cruelty charges. Father and daughter were at the Jersey shore when a seagull swooped down and tried to steal the daughter's French fries. Dad wasn't having any of that, so he grabbed the gull and decapitated it. I don't like to stereotype people, but his name is Frankie, and he is from Jersey, so this may not be his first decapping. And finally, a leftover nugget from last week's convention. Grindr, the dating and hookup app, crashed in Milwaukee because of unprecedented traffic during the RNC. This reminds me of an old saying, when the cat's away, the mice will play. All right, on the podcast today, we have Steve Giles, Joel Dresang, Kendall Bauer, and wrapping up the week, here's Kyle Titting.
Well, thanks, Max. A bit of a mixed week overall for markets. NASDAQ down 2.1%. Been in a bit of a slump recently. The S&P down 0.8%, down 46 points this week. But a positive week again overall for the Dow, up 0.7%, 300 points after adding 654 on Friday. For the year, starting to close the gap a bit between Dow, S&P, and NASDAQ, but still a pretty big divide. The NASDAQ up 16.1 on the year, the S&P up 15.3, and the Dow still a pretty substantial positive 8.8% on the year, all including dividends. You know, I think maybe, Steve, the place to start this week is just some of the volatility we've seen in stocks recently. At one point in time, NASDAQ almost 7.5% off its recent peaks, and I think a good reminder why, when we look at our portfolios, we can't just pick the best number we see and assume that's what things are supposed to be worth.
Yeah, Kyle, what a fantastic week to remind investors not to try to time the market. We got whipsawed this week with the markets trading down earlier, snapping back by the end of the week, but still finishing a bit down on the NASDAQ, but climbing back into the green for the Dow. The point here is that have a strategy, stick to your strategy, have a plan, and trust that allocation moving forward through thick and thin. If you react to the market, all you're going to do is make some irrevocable changes that you're not going to be able to undo because of a trade maybe brought on by fear or greed.
And to piggyback on that, Steve, I think sometimes down days like we've seen this week or even last week with the big swings down can be a bit deceiving. So, for example, the S&P, down intraday a little over 1.5% or 2% throughout the week. But if you dive into the 500 companies within the S&P, there was a point in time this past week where the vast majority of companies in the S&P were actually positive the day that the S&P was still down. So some of the big tech companies giving some of the nice returns back, but at the same time, some of the other parts of the S&P still rallying the same day. So,
Kendall, there had been this expectation that when we saw a broadening of participation in stock market returns, when it wasn't just 7, 10, whatever the number is, but certainly a lot less than the 500 names in the S&P, that you'd see things calm down a little bit. And in some sense, we haven't seen those 7 or 10 names up 30% in this stretch of, a couple of months. At the same time, we have seen a bit of a spike in the volatility index, kind of the expectation for where stocks are going forward. That doesn't mean downturns. It just means investors are thinking that maybe things get a little more rocky from here. They bump around a little more. But also, I think you start to see, okay, there's more people interested again in what's the direction, what's happening with the economy, what's happening with earnings in the middle of earnings season. And of course, I think you rightfully point out, if we were seeing a drastic shift in kind of the overall sentiment on earnings, you'd probably see the rest of those names negative, just like the Big 7, the Big 10. And on the other hand, what we have seen is, hey, the earnings picture is mostly shaken out the way we thought. I think the other big piece of news, Kendall, we've transitioned to this week is this Fed pivot. And it feels like ever now, but certainly for the last few quarters, we've been talking about when's the Fed going to cut, what would it take? All of a sudden, the last month or so, investors have really gotten on board with this idea that come September, the Fed is finally going to make that cut. We've got a Fed meeting on tap next week. You'll hear from some of the major players of the Federal Reserve. It's seeming more and more like potentially they have the cover they're going to need to make that first cut come September.
Yeah, and I think, seen a few positive reports coming through this week in the past few weeks on an inflation front, showing inflation, the rate of inflation coming back down. 2 years ago is when we hit, roughly, we hit that 9% number. And now we've subsequently come back down right around 3, maybe a little bit, below that. So getting to a point where I think, they're comfortable to proceed with, beginning to cut interest rates. The interesting part, too, is you look at the GDP report that came out, and not to jump ahead, we're certainly going to cover that in a little bit. But, for a while we were talking about how stronger economy was almost a bad thing, right? But we're seeing potentially an environment where inflation has come down, and yet GDP still, remains on track and even surprising, I think, pretty good number here this last quarter.
Yeah, Joel, let's dive into that GDP number because, I think a lot of mixed news we've been talking about economically. And when you look at gross domestic product, it's the one piece that tries to sum it all up. It's the one piece that says, okay, when you look at aggregate, what's that activity look like? And we got a reading on the second quarter here this week.
And looking at it in aggregate like that, Kyle, means that they're looking at a lot of different numbers, and that's why they update this twice. The report that came out this week was their first look at it, and there's usually an adjustment between those. It's also old data when you think about it. I mean, they're talking about, what happened in the second quarter of this year, and we're already 1 month into the third quarter. But that said, I mean, like Kendall said, it was a strong report. It was 2.8% annual rate of growth, and that's twice what it was in the first quarter. That's a pretty good clip. And you sent a note out earlier today, and you said that the economy isn't weak, but it's weaker. And so that's a sign. I mean, it's a sign that the economy isn't weak, that 2.8% growth. But if you start looking at some of the numbers, and even the numbers within that report, consumer sentiment numbers came out today. They're weaker. The job claims for weeks now, the job claims have been going up 6 out of the last 7 weeks. We're 13% greater initial job claims than we had going into the COVID recession. Housing, both existing housing and new housing, the sales are going down. So we're seeing greater weakness there. And within that report on the GDP is the inflation number. The inflation number is going down, and inflation is a sign of how much we're growing. And that's the good number of, I mean, if there's a good cholesterol, bad cholesterol, this is the good cholesterol that when it's going down, it means good things for the economy.
And remind me, is that the HDL or is that the LDL? Maybe some of our physicians listening can call in. I think the fun part about being in an economy that's still as stable as this one is that you can look at all these data points and go, yeah, but. And when you look at consumption and the consumer, which we talk about as, depending on which one of us you listen to, 2/3 or 70% of our economic output, that GDP number that we were just talking about, There's plenty of headlines recently that have pointed to cracks in the foundation, whether it's delinquency rates on credit cards and autos that have reached 12-year highs. The headline I saw this week, which when I went back to find the headline had changed because of how poorly written it was that credit card delinquencies had reached an all-time high. And then buried in the article was a note that said that particular data point had begun in 2012, which, as we all know, is after the great financial crisis, in which credit card rates had spiked through the roof. And when you look at related data that goes back to the 1990s, every data point since the financial crisis has been so far below anything you saw pre-great financial crisis that we're still talking about high watermarks that look nothing like what things look like before, because generally speaking, consumers have been better behaved, banks have been better behaved. And so the trend is always a concern. If consumers have less to spend, if they are stressed by higher prices, as so many are, if the rates with which we are paying back loans start to take a little bit of a dip, what's that mean for the system more broadly? But it isn't at a place in which we've seen the kinds of concerns we saw in the past that might be a little more alarming.
Well, I think that sort of lends to this whole idea that we're all victims of our most recent perceptions, right, Kyle? And if we're looking at data that says, credit card debt is as high as it's ever been, but we're only been tracking it for 12 years. I mean, I love reminding clients that for the last 50 years, inflation has averaged 3.8%. I mean, when I bought my house in the early 2000s, I was thrilled to get a mortgage for a 30-year fixed in the single digits, like 8.25%. And I have clients that tell me stories when they were buying houses in the 70s and 80s, and they were thrilled to get something in the low double digits. So we're always victims of our most recent perceptions, and I think that we have been somewhat spoiled in the last decade with respect to where inflation has been because rates have been so low. And a lot of what's happening is this either unwinding or returning to normal, if you will, from the overall economic data points 30,000 feet up.
Even more so because of COVID. We entered an environment in which you couldn't spend money where you wanted to spend it. Then you started getting money from the government and from other sources. And so I think we may finally be entering a post-COVID economy. It's weird to say because there's still holdovers all over the place when you look at
post-COVID meaning return to pre-COVID normalcy?
I don't know that it's a return.
Or pre-financial crisis normalcy?
I don't know that it's either. I think it's a return to whatever the new normal is going to be. And I think it's fair to say that the economy going forward doesn't have to look the way it looked 5 years ago. It doesn't have to look the way it did 15 years ago because clearly things have evolved. But I do think when you look at auto delinquencies, credit card delinquencies, rates of consumer spending maybe dipping a little in some areas, personal savings taking a little bit of a fall, it's just a reflection of the fact that some of those numbers looked so rosy for so many years coming out of COVID that this isn't a period of time in which, again, Joel, as you mentioned, I wrote in my kind of pre-show notes, this isn't a period in time in which the economy is weak. It's just weaker than what was a great economy.
And sometimes, Kyle, a lot of the times when I look at these numbers, I compare them to February of 2020, just before the COVID pandemic. And so a couple of those numbers you just mentioned, credit card delinquencies, it's 3.16% now. And just before COVID, it was 2.66%. So it's a little higher. But since 1991, that's been 3.73%. So it's lower than the long-term average. The savings rate we just found out today was 3.4% in June. In February of 2020, it was 7.7%. And one of the reasons that I look at February of 2020 is we had a pretty good economy then. I mean, if you think about it, we were talking about, gee, this looks pretty good. We should be expecting a recession soon because we're overdue, but things seem to be humming along.
If it weren't for that one thing, who knows where we'd be.
There's always that one thing.
We had to adapt.
Yeah.
We had to adapt. And so when I look at kind of where we are and I look at how smoothly we've been able to navigate the last few years, yeah, there were absolutely some bumps along the way, a big spike in inflation, Kendall, that you mentioned. the fact that when you see the personal spending number this week, Joel, and it shows a core PCE and a headline PCE that, it's not back to the Fed's target, but it's a much better number. I think, again, it speaks to we're finally returning to whatever normal is supposed to be now. You can't blame the pandemic anymore for, inflation's high because there's all this excess cash. Yeah, there's some out there still, but a lot of it's made its way off the books, and we should be starting to think about how are we going to create the support we need for this economy? What's going to be the foundation of what comes next?
There also has to be the realization that there's always that one thing out there that we don't know about that could disrupt us again.
I think that's fair. We talk about soft landing. We talk about, is inflation going to make it to 2? And then you go, okay, but are we going to start another trade war? Are we going to see another pandemic? Is that meteor from outer space going to get here? And so, it's the unknown unknowns that ultimately lead to that concern. And, Kendall, maybe a big selling point for the need to look at opportunities to take gains right now.
Yeah, absolutely. I think if you're somebody that has to take a required minimum distribution, that plans to do charitable gifting, given where markets are, again, Kyle pointed out at the beginning of the show, S&P closing the week a little over 15%, NASDAQ 16%, Dow almost 9%, and we're halfway through the year. I think it's a fantastic time to talk to your advisor, revisit your allocation and your portfolio, but maybe consider taking some gains off the table as we approach a point in the year where it's not to say that we feel there's going to be a pullback, but you say, okay, you look at the rally stocks that have been on the last 7 to 8 months, and then you look at the likelihood of a slowdown as we approach, the election, where we know there will be more volatility due to the uncertainty. I just think that's a great idea. I would rather be a little bit early and take some gains and use it for things that you may need to than, try to do it later in the year when things could be, jumping all over the place.
Makes sense. Steve, Secure Act of 2020 created these wonderful rules that then took the IRS 4 years to come out with clear language on what they meant. We don't need to go too into depth on the 260 pages of IRS guidance that came out over the last couple of weeks, but I do want to touch on a question that comes up quite a bit with IRA owners with respect to what happens to their accounts for beneficiaries. The big change we'd all been waiting on is what's going to be the requirement for withdrawals. And the IRS has finally clarified the guidance on what's supposed to happen with IRA beneficiaries.
Yeah, I think it's a very important finalization here that we have been waiting for. And as a reminder to our listeners, we're talking about inheriting monies from a non-spouse IRA owner. Obviously, if you're the spouse and you're the beneficiary, you take over that IRA with no tax consequences whatsoever. You just assume it as though it's always been your own. You can roll it into your own IRA. But if you're a non-spouse beneficiary, a child, a sister, a brother, a nephew, there are some certain rules that you have to follow. In a nutshell, if the original owner had already begun taking their required minimum distributions, which right now is age 73 or above, then the inheritor must continue to take a required minimum distribution each year, and they have 10 years to draw down the entire account. If you inherit an IRA from the original owner who had not yet attained the age of 73, you do not have to take an annual required distribution, but you still have to draw the account down within 10 years. Obviously, with whatever the situation, you should consult your accountant, consult your financial planner to make sure that the decision you make is right for your personal tax situation, because the money that comes out of those IRA accounts is taxable and does get added to your income.
I think such a critical reminder how important it is to revisit those beneficiary designations, to make sure that your intentions are clear, to make sure that the people you name or the entities that you name are done in a way that's as tax advantageous as possible, that doesn't burden someone else with a tax liability that could better go to some other place. And so it's a conversation I have in every client meeting. Is this really what you want? Is this still what you want? Is there anything else you might want to add here? We have been given reprieve for 2024 from the IRS on those annual distributions. Same thing we saw in 23, 22, 21. But I do think coming 2025, those annual distributions that, Steve, you were talking about are going to be back on the table. Seems unlikely now that the official guidance is out 4 years in that we get another delay in that. And so if you are an inherited IRA owner, probably want to start to plan, okay, what's next year going to look like?
Yeah, and just to piggyback on that, Kyle, if I'm understanding the way the passage of the law was written, if you inherited an IRA in 2021 and you're under the 10-year rules, but you've not yet taken the RMDs because the IRS hadn't decided, it's not like you get the 10-year window beginning next year in 2025. You still have to draw that account down before 2031, which would be 10 years from the time at which you originally inherited it. You just got to pass on having to take out the required minimum those first couple of years.
Yeah, you got it. Plenty of news to come, I'm sure. Some more clarity on Secure Act 2.0 probably in the works at this point now that they've finalized the original Secure Act.
One thing to clarify, and this may kind of be obvious here, but this only applies to inherited IRAs after the start of 2020, if I'm not correct. So if you're somebody that's had one for years, this does not affect you. This is specifically for those that inherited, non-spouse beneficiary that inherited an IRA after 2020.
Yeah,
just throwing that in.
Thank you for that clarification, Ken. Yeah, plenty of beneficiaries pre the implementation of Secure Act that can continue on with the plan as they have. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.